All right, welcome everyone. My name is Joel Wattenbarger, and I'm here with my partner Jason Brown, and we'd like to welcome you to the inaugural presentation in our 2020 Regulatory Update series. You may recall that last fall we had a Regulatory Updates conference in which we held presentations in person in New York, Boston, and San Francisco. We're sorry that we can't join you all and see you all in person this year. But we're excited, in lieu of an in-person conference, to launch this weekly event, which will run through mid-November. Today's session will address recent developments and updates in the regulatory landscape, with a focus on regulatory trends, insights, and challenges facing private fund investment advisors and updates on market practice. The next presentation in this series will be next Wednesday, October 21st at 12 p.m. Eastern, and will address recent enforcement trends. Other topics in the series will include implications of the Department of Labor fiduciary rules, European regulatory and policy developments, new ESG regulatory guidance, and recent broker-dealer issues. And so we hope you're all able to join us for each of these upcoming events. If you have any questions during this presentation, we would invite you to ask them using the Q&A function on Zoom, and we will try to address them over the course of the session, time permitting. And of course, we're always happy to discuss these matters and any other questions that may arise based on today's presentation. So just briefly, by way of personal introduction, my name is Joel Wattenbarger. Again, I'm a partner in our asset management group, resident in our New York office, but currently resident in my Brooklyn home. And my practice is a private funds and fund regulatory practice with a major focus on advising clients around US regulatory issues generally. And with that, I will hand it over to my partner, Jason, to introduce himself and get us started.
Great, thanks, Joel. So my name is Jason Brown. I am a partner in our asset management group. I'm in our Boston office. My practice focuses on regulatory issues for investment advisors with a particular focus on private fund managers. So with that, let's go to the next slide, slide 2. All right, so this is the agenda for our session today. We're going to start off with a brief note on fiduciary duty, and then we're going to talk about SEC exam trends, the general state of play, what we're seeing now on exams, the key issues that we're seeing, some ongoing common issues, things we've seen before that are still going on, and then briefly touch on some published SEC and related guidance. Next slide, please. So we're going to start off with a discussion of fiduciary duty. Now, you're all probably wondering, gee, I signed on to get SEC exam trends. Why are you telling me about fiduciary duty? Well, we thought it made sense to spend a couple minutes here because everything we're going to talk about deals with a breach of fiduciary duty, and we thought it was helpful to have it as background. So, as I'm sure you all know, the Advisors Act imposes a fiduciary duty on investment advisors with respect to their clients. Now, if you manage funds, the client is your fund. It is not the investors in the fund. Most of the time, their interests are going to overlap, but they don't always. For example, I got a recent question about a tax issue. You answer that in the best interest of your client. Now, here's the key piece, and this is going to flow throughout the whole presentation. It is a disclosure-based fiduciary duty. So the way I like to think of it is, you have to act in the best interest of your client unless you have clearly, specifically, and timely disclosed how you're not going to act in the best interest of your client. And I know a lot of times that formulation shocks people, and I always like to give an example with respect to allocation, right? Let's say you have a flagship fund that invests anywhere, and you have an Asia fund that invests in Asia deals. And you disclose to the flagship fund investors, all Asia deals are going to go to our Asia fund. And only if the Asia fund is fully satisfied do you get any scraps that might be remaining. Now, is that in the best interest of the flagship fund? No, the flagship fund would like to get more Asia deals. But have you breached your fiduciary duty? Absolutely not, because you gave clear, specific, and timely disclosure. And what Joel and I and our enforcement colleagues spend a lot of time with the SEC on during an exam is, how specific was the disclosure? Was it clear enough, right? We've learned over the years, saying that consultants are a fund expense not good enough to have an operating partner program. Saying you can charge monitoring fees is not good enough to charge accelerated monitoring fees for services you won't provide. Now, you can breach your fiduciary duty even if LPs aren't harmed, if there's an undisclosed advisor benefit. So the example I like to give here is there was a recent case involving an affiliated service provider where the owners of the advisor also own the service provider. The services were required by the fund. The services were of high quality. The services were at less than market rates. LPs clearly benefited from this, but the SEC still brought enforcement because they did not disclose that the service provider was affiliated. And finally, the one piece of good news here is that only the SEC can enforce a breach of fiduciary duty. Investors don't have a right of action, but be careful. On a lot of side letters, investors request that you make a rep that you're going to act consistent with your fiduciary duty. Seems like an obvious thing to give, except you have just turned something that was not a right into a contractual right of action. So again, something to think about. Next slide, please. All right, so now that we have the fiduciary duty background out of the way, let's talk about some general trends. So here's the thing. Exams slowed down in 2019. Couple reasons for that. There was the government shutdown earlier in the year, and the SEC was left playing catch up. I think the SEC focused more on kind of retail investment advisors. So since we're primarily in the institutional space, we didn't see a lot of activity. But that changed dramatically late in 2019, and we saw a huge uptick in the number of exams of institutional investment advisors. Now, there was a slowdown again in late March, early April because of COVID, but then exams came back with a vengeance after that. And in fact, the exams that we saw up until September 30th, which is their fiscal year end, they actually moved through them pretty quickly. We saw a lot of exams that finished sooner than we would have thought. We saw lighter deficiency letters than we've traditionally seen in the past. And again, I think some of that was that the SEC was playing catch up. I have to say, within the last month or two, there's been even a larger uptick in exams. I have to tell you, my personal experience, I think I've had one client, start an exam every week for the past 8 or 9 weeks. It's been really, concentrated. Enforcement still happening, although we're seeing less broken windows. I'm not going to get into detail on this. My enforcement partners are going to be giving a presentation next week. Don't want to steal their thunder. The other trend I wanted to note is that the SEC has been doing limited check-in exams within 1 to 2 years of kind of a prior hairy exam. In other words, these are exams that had lengthy deficiency letters, maybe an enforcement investigation, but that didn't go very far. And, it's the old lesson. Always make sure that you're doing what you told the SEC what you would do in response to a deficiency letter. And a lot of times it's easy to do that in year 1. But, if you're in year 5, it's a good idea. Go back and make sure you're actually still doing what you told the SEC you would be doing. So let's go to the key issues list. This is where we're going to spend most of the time today. This is really like a table of contents. These are the issues we're going to touch on. The one thing that I want to note here is that we are going to be focusing not on every issue that's out there, but we're really focusing on the issues that are kind of new and novel within the last 6 to 12 months. So, if you charge accelerated monitoring fees, the SEC is still going to be interested in that. But we're not going to touch on that today because, again, it's kind of old news at this point. And with that, I'll send it to Joel.
Great. Thank you, Jason. So the first key issue we're going to examine is material non-public information, the use or potential misuse of MNPI. And I think folks won't be surprised to know that the SEC looks at issues around handling of MNPI in a number of exams, and that's been true for certainly as long as I've been practicing. This is always going to be a part of what OC is looking at in investment advisor exams. And then having said that, I would say that there has been a clear increase in focus of this issue by the SEC over the course of the last year. And to flesh that out a little further, there have been a few specific developments or signs of SEC focus on this There was a statement issued by the co-heads of the Division of Enforcement at the SEC in March, shortly after the beginning of the COVID crisis, really flagging the significance of abiding by MNPI policies and procedures and the heightened risk of insider trading violations during a time of market turbulence and a time where there was just potentially more and more significant MNPI being generated as firms dealt with, kind of all aspects of the crisis. So that was earlier this year. Then in June, we saw a risk alert from OC that was summarizing a number of different issues that they've identified in the course of conducting exams of private fund managers. But one of the issues that they really highlighted in that report was the use or misuse of MNPI and policies relating thereto. And then finally, and again, we're not going to talk a lot about enforcement matters, but there was a significant enforcement case, the Ares case this summer, that kind of went directly to certain policies and procedures around handling of MNPI. So just clearly an area of focus, and an area of focus really in two ways, right? The SEC, including on exams, is looking for instances where in connection with particular trades or particular investment activity, there may have been a violation of the law of insider trading, but they also look at it very much as a standalone compliance policy issue. And they ask the questions both in general, are your policies sufficiently robust? And then specifically, have there been specific events around the handling of certain information or around certain trading activity that suggests that there are weaknesses in your policies and your controls? We've seen a number of deficiencies in recent exams relating to MNPI. We've listed them here on this slide. I would say if there's a sort of a common thread that runs through these deficiencies, it's cases where asset management firms over time, they evolve. They pursue new lines of business. They pursue new investment strategies. They set up new affiliates or enter into new joint ventures. And it's really important that when that happens from a legal and compliance standpoint, you are thinking through what sorts of new types of information are coming into our firm as a result of these new business lines, these new investment strategies, new personnel, new joint ventures. Do we have a good understanding of all those types of information, and how are we managing that information in the context of our policies? And that could mean establishing information barriers. And if you're establishing an information barrier, it's important that, of course, the information barrier is robust. The SEC will test the barrier, look for gaps in the barrier, examine who has oversight over the barrier, who sits on top of the wall, right? They'll also want to be sure that everyone on the other side of the barrier, you could have multiple lines of business that aren't walled off from one another. So those really need to be working in conjunction in terms of restricted lists, watch lists, compliance policies and procedures around the handling of MNPI. And again, I think most of the violations that we're seeing on exams in this area, ultimately reflect circumstances in which firms had evolved, they had expanded their business in various ways, and their MNPI policies and procedures hadn't sort of kept pace with the evolution of the business. In terms of other areas, the other areas that we see the staff focusing on an exam in this, in this space are, I think by now, relatively familiar. For several years now, the staff has been very interested in how the compliance groups within a firm are tracking communications and contacts by investment professionals with public company employees. Does compliance know when those conversations are happening? Is there a log that's maintained? Do your personnel understand what the rules of the road are in terms of what they should and should not be discussing? Are those communications ever chaperoned? These are the sorts of questions you'll get from the SEC. So you'll want to think about what the answers would be. Similarly, certainly for hedge funds and other firms that regularly trade in public markets, they want to understand what compliance understands about the rationale behind the trades that the firm puts on. And is there a good record that's kept as to why certain investments are entered into? Even if there's not a robust written record, does compliance understand, at least at a high level, what is motivating the trades that the firm is putting on? And if they don't, then that's a concern for the SEC. And then another issue that's been with us for a number of years now, but certainly continues to be an area of focus on exams, is firms that use expert networks, use political intelligence firms, and what are you doing in terms of policies and procedures, and are you following your policies and procedures in terms of overseeing those communications and ensuring that that's not a means of MNPI coming into the firm. And then the last thing I'll note briefly, and again, not to go into great detail on the recent Ares case, but that was a case that at heart was about an SEC finding that the firm in question had not instituted sufficient policies and procedures to ensure that when the firm was trading during an open trading window of the company, that no one at the firm had access to material non-public information, or was in possession, I should say, of material non-public information. So if you haven't reviewed your MNPI policies and procedures in the wake of Ares, would encourage you to do so. And there's lessons there, both in terms of the content of your policies and procedures, as well as how you're documenting what you're doing before you pre-clear trading in a circumstance in which the firm might have access to material non-public information about a public company. And with that, I will turn it back over to Jason for our next topic.
Great, thanks, Joel. So affiliated service provider arrangements. What do I mean by that? I mean almost everything, right? I mean employees providing services to funds or portcos. I mean having an affiliated consulting firm, an affiliated property manager, even in some circumstances having an operating partner program. And here's the thing. Over the past, say 5 years, 7 years, the SEC is focused on, did you have disclosure? Well, disclosure's evolved over the last few years, and everyone now does have disclosure. So the SEC has shifted, right? What they've done is they've looked at how you implement your program and is it consistent with your disclosure? Again, this is why we started with the fiduciary duty lesson, right? Have you satisfied your disclosure-based fiduciary duty? So the first, the inquiry can take many forms. If you promise that fees will be charged at market rates, did you actually charge them at market rates? The SEC expects that you will have done some diligence. There was a recent enforcement action, the Rialto case, where a firm went over 4 years without rechecking market rates, and the SEC brought enforcement. So clearly you've got to update that on some sort of a regular basis. Are you looking at it at the company level, right? Or the fund level? Are you meeting market for each company? Or are you meeting market with respect to your fund as a whole? Do you have the right comp sets that you're looking at? A great example was a real estate client of mine. They had a property in Kansas, and they were checking their rates against, national property managers, nationally recognized property managers. And the SEC said, well, shouldn't you have checked against like a Kansas-based property manager to see how that would have worked out? We've even seen recently, have you taken discounts into effect, right? Are you checking against rack rates? Does anyone actually pay rack rates anymore? This is the depth in which the SEC looks at that issue. If you're making equity payments to a service provider, they expect that to be disclosed. Are the services the same as those described? Right. So ultimately, if your LPA says that your employees can do tax and legal services, you can't charge for HR services. We had one particular horror story experience where an affiliated property manager was allowed to provide on-site property management services, and it didn't make sense to have a lawyer at every property. Because they just didn't need all that time. So they had, say a single lawyer on site at the advisor providing services to multiple properties. And the SEC came in and said, well, that lawyer's not on site. We had a lot of back and forth on that. The point being, the SEC will read your documents literally, even if it sort of doesn't always make rational sense. And as you're looking at what you've disclosed, it's critical that you're looking for things like the on-site property management, because you would say, gee, Really, I'm supposed to put a lawyer at every single property at massive, and have them twiddle their thumbs for 80% of the time, and then it's okay. So again, just important to read your disclosure, like I said, almost, literally. Are the services being provided by the same personnel you've disclosed? Disclosing that a senior advisor can provide services without offset, can charge for services without offset. It's not the same thing as saying an employee can provide those services without offset. Do you have any LPA provisions kind of sneaking in the background that could create an issue for what you're doing? For example, we had a client where it said that the expenses of a service provider could not be charged if a fee is already being charged by that service provider, right? In other words, that if you're charging a 2% fee, you can't charge the 2% fee plus reimbursement of some of their expenses. That's easy to miss. And again, it's the same lesson. If you're going to be doing this, critical to be reading those documents carefully. Including overhead costs or profit element in expense reimbursement unless they're clearly called out. So if you have an employee providing services, is it salary? Is it salary and bonus? Is it salary, bonus, and benefits? Salary, bonus, benefits, rent? Pro rata portion of the IT, and human resources folks who are also at your firm. Again, fiduciary duty. It's okay if you've disclosed it, but you got to make sure that you have disclosed it. And then allocations of time, expense, and cost without sufficient backup or precision, right? You can't just kind of say, well, people are providing services, we make an estimate, and we charge. That's not good enough for the SEC. An almost universal practice, the most common practice is, again, if you're not sort of charging a fee and you are charging based on expenses, people are keeping track of their time. It doesn't mean you have to keep track of time on a quarter of an hour basis the way a law firm might, but there should be some relatively contemporaneous time tracking. And not only should there be tracking, someone should be looking at it. Are these the services we would expect to be performed? Is this quantity about right? The same way that you might look at any service provider bill, you should be looking at this as well. Next slide, please. So this is just a flow chart illustrating what I just walked through. I don't think we need to spend a lot of time on it. We can go to the next slide. So fees and expenses more generally, right? Affiliate service providers is one slice of that. We thought it was worth breaking out just because it has been such a huge trend over the past 6 to 12 months. But our old friend, fees and expenses, what are some of the more recent developments? Looking for expenses not authorized by your LPA, right? So if you, if you're going to charge compliance, advisor compliance, that better be really well disclosed in your docs. If you're going to charge a management fee during a fund extension, do your docs allow that? Do you need to get an LPAC approval for that? Those kinds of examples, like I said, of stuff that is just hiding in your LPA. You've got to make sure that what you're doing is consistent with that. Recycling. The SEC has been really into examining, are you recycling consistent with any limits in your docs, right? Recycling meaning an investment returns some money, instead of sending it back to the investors, you reinvest that money. And the SEC is interested not only because it would be an LPA violation, but because that is a way that management fees can be higher, right? Because you could ultimately invest more capital than, say the capital that has been committed. Expenses not borne by certain funds despite a shared benefit, right? This is the old broken deal, not being allocated to the employee co-invest vehicle. I don't want to spend a lot of time on that. That's old news. By the way, for the record, still haven't seen a lot of action with respect to deal-specific co-invest vehicles on broken deals. Still haven't seen the SEC suggesting that those should be bearing broken deal expenses. But there are other expenses like this. Research is a tricky one, right? You might have one affiliate research a company, they decide not to invest in it. Another affiliate decides to invest in it. How do you split those research costs? How do you split the cost if two clients co-invest at the same time? Again, who's getting the benefit of the expense? Now, in light of the fact that, fund lines of credit have become extremely common, the SEC is looking at the expenses relating to that, right? So, if you say have a main fund that has a line of credit and it buys a company and then syndicates part of that out to a parallel fund, is the parallel fund paying its fair share of the financing costs of carrying that investment? On a related note, they're also looking at expenses allocated to co-investors. So I mentioned, with respect to deal-specific co-invest, that, dead deal costs still haven't sort of made it to the surface there, but other expenses sure have. So is there an insurance policy paid for by the main fund that also benefits the co-invest vehicle? Are there closing costs with respect to an investment that the co-invest vehicle should be bearing? Sometimes those are brought into the funds flow, so it's borne by the portfolio company. It's not a big deal. But if it's not, the SEC expects those to be shared with the co-invest vehicle. And borrowing costs, just like we ran through. It's not just parallel funds, it's also co-invest vehicles. Loan guarantees, is one fund agreeing to guarantee the debt of another fund? And if so, what are the circumstances, and is it in the best interest of the fund that's making the guarantee to be taking on that financial liability? Staying on fund borrowings, interest costs. A lot of times LPAs will say what you can do with the proceeds of fund borrowing. And so, are you going to use it to pay management fees? Are you going to use it to pay placement agent fees? You should be comfortable that your LPA does allow those. Expenses of the advisor being allocated to a fund or an investment that could be considered overhead. Still a big issue with the SEC. Frankly, the best example is still platform companies to employ certain individuals who would have otherwise been investment personnel. Again, that's old news. I'm not going to stay on that a lot. Insourcing, this is where you have your employees providing services that normally a third party would. I've more or less covered that on the prior slide. Excessive fees and expenses. 10 years ago, we saw a lot more emphasis on things like, is the hotel too expensive? Is it a premium meal, a black car? We're not seeing that quite as much anymore. They want to make sure that the expenses are appropriately borne by the right party. So if you, have basketball tickets, are they really appropriately expensed to the funds if you're going to be entertaining with them? Private plane travel is still very interesting to the SEC. And the one word of warning I would give you is a lot of you might have docs that only allow you to charge first-class rates for private plane travel. And you might be using private planes more now that kind of COVID has hit. And it's important to kind of look through your docs and see how that can actually be charged back. And then expenses benefiting the advisor, like, insurance premiums. If the advisor benefits from the policy, they should be paying their fair share. Really, the conclusion of this slide is, with respect to any expense, anyone who benefits, the SEC is expecting that they're paying their fair share. Next slide, please. All right, so valuation issues. This is an oldie but goodie. It's been around forever, but we've seen a pretty big resurgence in this in wake of COVID-19. Pretty much everyone, not everyone, but in most exams that I've been a part of since March, the SEC has been poking at valuation. Why? Well, because anytime there's a market disruption, the SEC is interested to see what people do with their valuations. And the number one thing that they're looking for is a change in methodology, right? And for example, I had clients where they were using market comps to value. The stock market, as you may remember, was way down at that point, and they'd look at a company and say, gee, there's no way our company's worth that little. We know what the cash flows are going to be. And so they start to value based on a discounted cash flow analysis. Now, there's nothing inherently wrong with that, but it's critical, and it's a red flag for the SEC. So it is critical that you have great documentation for why you've made that change and why that change is appropriate. There are other issues the SEC is looking for, right? Like credit markets had locked up. And so people were having trouble getting good quotes on any credit instruments that they had. And, folks were not necessarily just taking in a very illiquid market, whatever the last trade was. Again, nothing inherently wrong with that. You're not required to take a fire sale price for your valuations. But again, critical, you're thinking carefully about it and that you are, creating good backup for that. The SEC continues to look at, are you reviewing and testing your valuations? They do expect you to be doing some back testing with respect to sales. And as always, they're looking at your procedures and making sure that you're following them. Next slide, please. So another issue that's coming up related to valuation is the fact that in a lot of closed-end funds, management fees are based on invested capital unless something has been materially written down. The standard's different in every LPA. It's been materially written down. It is worthless. It has been written off for tax purposes. There's a different standard in every LPA. And when companies have become distressed, the SEC has been looking very carefully at how quickly did you write it down, just as a valuation matter generally, right? If you're disclosing returns, how quickly did you write down that investment? Number one. But number two, how does that affect your management fee? Right? In other words, if it hasn't been written off for tax purposes. When exactly is, have you taken that cut out of your management fee? We even had a situation where a client had a portfolio company that was a holding company, had two subsidiaries. One of the subsidiaries got sold, and the SEC said, gee, isn't that a disposition for purposes of calculating your management fee? In light of the fact that one of the subsidiaries was sold. So this is a priority for the SEC. In fact, Igor Rosenblit, the co-head of the private funds unit, has actually said as much to us. So the key thing is, as you have companies that are in distress, it's important that you're taking a close look at, what is the value of this company? Are we writing it down quickly enough? And have we hit whatever standard we have for writing down our management fee? Joel?
Great, thanks, Jason. So if we can go to the next slide. Great. So, the next sort of series of issues are all under the heading of, issues relating to affiliated advisors. And there's a lot on this slide. A lot of this we're covering or have covered in other portions of the presentation today. But I think, if you step back and think about the big picture here, it's very similar to what I said in the MNPI context, but just even broader, right? If you've got multiple affiliated businesses across your, business, are you consciously thinking through, as each of those affiliates are established or a new relationship is entered into, what are the conflicts and what are the compliance issues that may be created by virtue of those relationships, right? And then, once you've done that identification process, have we made adequate disclosure? Or if not, let's disclose now. And then what are our policies and procedures to address the various types of conflicts or issues that may arise? And so, just to walk through these briefly, obviously, an ongoing potential conflict where you've got multiple affiliated advisors is allocation of investment opportunities. And, to what degree is there overlap between the investment strategies and investment programs of multiple advisors or multiple products under a single advisor? How does the firm as a whole resolve those conflicts? Has this all been disclosed to your investors? And how do you determine how investments get categorized, which then affects how they're allocated based on your overall global allocation policy, right? Cross trades. The SEC will be very focused on virtually every exam. They will ask a question as to, have there been any cross trades? Have there been any principal transactions involving your clients or your clients and your firm? And then, really digging into what is the process there. Did you give notice to investors both at the outset when they entered into a given fund or other investment product as to the potential for cross trades? Was there an obligation under your fund documents to obtain consent, and how was that process undertaken? How did you determine the price at which clients would be transacting with one another? And then obviously just crucial that you're aware of the Gardner-Russo guidance, the 25% ownership threshold. So again, if the advisor or the advisor's principals or other affiliates own collectively 25% or more of a fund or other investment vehicle, the SEC will view that vehicle as a principal. Any transaction between that vehicle and another advisory client will be deemed to be a principal trade. And you'll need to go through the advanced disclosure and consent process required for any principal trade. Joint transactions, we see so many different flavors of transactions in which multiple clients and potential multiple affiliated advisors are participating in a variety of circumstances, whether it's, one client is investing in equity of a company and another client is investing in debt of the same company, whether it's, co-investment scenarios, whether it's, differing interests of differing parties in a fund recap or fund restructuring transaction. Just very important that you're recognizing the potential conflicts there, that you're really thinking through these transactions from the perspective of each client across the various affiliated advisors and saying, does this investment decision that this client is making make sense for that client, not just in the context of the overall interests of all of your clients in a transaction. Again, this disclosure is always key across all of these issues. To the extent that you can foresee that there are categories of transactions that are going to give rise to conflicts, the greater the extent to which you disclose those up front, the better. If you haven't disclosed them up front, then you have to think through what are my obligations from a disclosure and consent standpoint going forward. Fees and expenses, I think Jason has already addressed at length, but just to note that obviously, affiliated advisors, have to be mindful of who's actually bearing the cost relative to who would actually participate in a particular investment and in what proportions. And then walls I spoke about previously earlier, but just very important that you're thinking through, do I need walls? And if so, how are they being established and maintained as between affiliated advisors? Next slide. All right, so we have several slides here about marketing, and it's interesting. Obviously, there is currently a proposed advertising rule. We expect that there's a likelihood that that rule will be finalized before the end of the year, is my expectation. And so I think it's fair to assume that advertising, once that rule has been finalized and goes into effect, and there is a year-long transition period under the proposed rule, so this is going to be a somewhat lengthy process time-wise, but I fully expect that this will be a major focus of investment advisor exams, assuming that we do have a new final advertising rule here in the near future. Over the last year, I would say, some exams have not focused significantly on marketing. But there are a couple of areas where we do see an ongoing focus currently, and many of them just relate to various performance presentation issues. And we've listed these. Most of these are not really sort of brand new issues, that things we've seen for at least several years now. But those include, the effect of the use of subscription lines and credit facilities on IRR calculations. And different clients have taken different approaches in terms of how to present performance and disclose to their investors the effect of these arrangements. But certainly it's important that if you're entering into these arrangements and if you're disclosing performance that is affected by these arrangements, that you really think through, am I making clear to my investors what they're seeing and what the basis of the performance I'm showing them is. Similar in terms of the effect of recycling on fund performance, including IRR and multiple calculations. Calculation of net IRR. I'm sure everyone is familiar with the Clover Capital rules around net and gross performance, but we see the SEC continue to ask, what does net really mean in the context of vehicles where there may be significant participation by non-fee paying investors, and how is that being disclosed to investors? Next slide. And some other issues that we're seeing, certainly, cases around predecessor advisor track records and whether, circumstances in which personnel or teams have moved from one advisor to another advisor. Is it appropriate to show the track record of the predecessor advisor and marketing for the successor advisor? We have seen a couple of instances in which clients of ours have received document requests where our client was not, in fact, subject to an exam. But clearly the SEC was looking for information based on what they had been told in the context of a subsequent advisor's exam. And so very clear that this is an issue that the SEC is sort of actively looking at. Important to understand where you stand if you're using predecessor advisor in any of your marketing materials. And then pro forma performance and projected performance. The SEC is just going to look at a variety of issues there, including, we see lots of cases in which advisors are presenting, sort of a subset of performance in connection with marketing various products or strategies. The SEC will want to understand, what is the rationale for pulling out that subset? Was there a good sort of objective process in doing so? Have you accurately disclosed the assumptions behind the pro forma performance? And are you presenting it net of fees, to the best of your ability, again, consistent with the Clover Capital requirements? And, similarly, projected performance, the SEC wants to see disclosure of the assumptions that are going into any projections. And of course, if you're marketing through a registered broker-dealer, you need to be aware of the FINRA rules in the space as well. All of this, assuming we have a new final rule that is consistent with the proposed rule, will fall under the heading of hypothetical performance under the proposed rule. And there's actually a requirement in the proposed rule to adopt policies and procedures specifically around the use of hypothetical performance. So I think these last two bullets are ones that are going to continue to be a significant area of focus, again, if we have a final rule sort of as proposed in the space. Next slide. And then the one other thing I think to say on marketing is really just more of a process issue. But we've just copied a very common request that we see now in initial exam letters, which is, basically, give us a log of every presentation you've made to an investor over the exam period, and what was it, when was it distributed, who received it, and so they're really kind of digging into process. I also see questions come up based on email reviews, which we certainly don't see in every exam, but we see sometimes where the SEC is asking about the process around certain communications with investors. So important to have a good buttoned up process with continuous involvement by compliance. And again, this is a bit of foreshadowing because the proposed rule actually would impose a specific requirement to pre-clear all advertising by a designated compliance professional. So, this is really, I think, indicative of the concerns that the SEC has in this area. They're asking about this on exams regularly, and they're also from the Division of IM seeking to impose a rule-based requirement going forward. Next slide. So just briefly to discuss ESG, I think this is maybe a trend in the industry generally, as we see increasing numbers of advisors that are either offering ESG products or at least describing an ESG process as part of just their regular investment program. And so, in response, we're seeing OC really scrutinize both sort of disclosures around ESG and then whether practice by our clients sort of matches the disclosure, right? So is there substance to ESG, or is ESG just sort of something that's being presented from a marketing standpoint, but there's not really a substantive process backing that up? So, I would just sort of focus on the key takeaways at the bottom of the slide. It's important, particularly in the context of, any sort of offering materials or advertising that is touting an ESG strategy or an ESG process, that there are policies and procedures in place that correspond to those disclosures. And just to note that the SEC has on exam really conducted even an investment by investment review to satisfy themselves that the ESG process was applied at the level of an individual investment. Next slide. Yep. So the last topic I'm going to address here with these key issues before I turn it back to Jason is issues around electronic communications, electronic messaging, and not a new issue, but a very difficult issue, and one that I think is an increasing focus for many of my clients. We had an alert a couple years ago from OSI in which they suggested best practices. I think the reaction of many of us was that those best practices probably exceeded both what many in the industry were doing, but also, frankly, exceeded in some ways what was realistic, at least with respect to certain types of communications and certain jurisdictions. And we continue to see the SEC ask questions on this topic in exam. They're aware that advisors and advisor personnel are using a variety of communications platforms in a variety of contexts, very much including messaging apps in China and other non-US jurisdictions where that's sort of a fundamental way in which business is conducted. And they're asking the questions: are these sorts of messages required messages? Are they being archived if they're required messages? If the position is that we're not using these platforms for any required messages under the Advisors Act Books and Records rule, how is compliance testing that? How are they able to ensure that that's not happening? So what sort of training and guidance is being given to your investment personnel in this area? Important subject, and I think made even more important by the COVID crisis and the fact that there's a lot that's happening, obviously remotely currently, and has been over a number of months, and will continue to be presumably for the foreseeable future. And so, I think there's a sense that there's a heightened risk in this current environment of investment professionals using other means of communication other than the sort of firm-supported email or other electronic messaging platforms. And so worth giving some serious thought to how you're overseeing and managing that risk in this environment, given the exam interest we're seeing. And with that, I will turn it back to Jason.
All right, so speaking of post-coronavirus issues, we're going to address some things that we've been seeing recently. I already talked about valuation. Joel already mentioned, in terms of marketing performance, it's closely related to valuation, how the COVID crisis is affecting that disclosure. But what I really want to focus on are business continuity plans, investment style drift, and other MNPI issues. So next slide, please. So pretty much every exam post-March, the SEC asks questions about your business continuity plan. Now, here's the interesting thing. It's pretty clear to us that they're just information gathering at this point. They're not kind of going, we don't have a single client who's gotten a deficiency based on any of the questions. My prediction is I'll bet we'll see a business continuity plan rule. You may remember one was proposed 2 or 3 years ago. I wouldn't be surprised if we see one adopted in the next year or so. And they're just gathering info for that purpose. So you guys have hopefully all seen the standard business continuity plan requests at this point. They're on the slide. I want to highlight just a couple of things that might surprise people. The first is, there's a strong interest in cybersecurity, making sure that people have taken into account the cyber concerns, into account as they're kind of structuring their programs. Have you developed a reintegration plan, right? Like, how are you going to bring people back into the office? The SEC expects you to be doing diligence on your service providers. To make sure that, anyone who's critical to you, you're overseeing, how is their business continuity plan functioning? Are they having any issues? Is there anything you should be anticipating? Along the lines of what Joel was saying before, right? What kind of training and reminders are you giving your personnel about, just use our systems, keep information confidential, right? Are you printing docs and just leaving them out in your home? Do you have literally a screen facing, that anyone in your house could be seeing? And again, resist the temptation to go to your phone to text if that's not otherwise acceptable. We've talked about information and confidentiality protocols, pandemic procedures. The SEC is asking if you have pandemic procedures. To be frank, most of my clients didn't. And the concept was a business continuity plan covers anything that could go wrong. Could be a terrorist act, could be, you know, a hurricane. But we do have some clients who are starting to develop pandemic procedures, which are obviously based on the rest of the BCP, but at least so that they have something. Next slide. Investment style drift, right? Whenever goofy things are happening in the market, a lot of times people adapt their investment strategy in order to be able to invest in those things. So for example, we had a lot of our private equity clients who were calling us because they wanted to buy, you know, bank debt of their portfolio companies. They saw it was trading really low. They knew it was worth more. They wanted to invest. It's critical here that you make sure that those kinds of deviations are consistent with your investment objectives and strategies. Additionally, from an allocation perspective, is there a duty to offer provision, right? Do you have a credit affiliate that has the first stab at those bank loans? And if so, are you keeping that in mind as well, as you know, you might have some investment style drift. Next slide. Joel alluded to this already. You know, the SEC is focused on MNPI. Anytime there's a dislocation in the markets, you know, a couple of things that I just want to note. We've seen an uptick in FINRA and SC inquiries around pharma, right? Especially in the COVID-19 space. And, you know, it is important if you're, say, a PE firm and you're going to buy the debt of a portco to be thinking about MNPI issues that you might have. Obviously, as you can see from the first couple bullets, it's kind of an open question as to whether bank loans are subject to the MNPI regime, but again, important to have thought through that analysis. Next slide, please. Undisclosed conflicts of interest. We have a number of undisclosed conflicts on this page. You've seen most of them. A couple I want to pause on. Alternative data. So this is like data scraping. Two things to keep in mind. Are you scraping material non-public information? And if you're going to scrape the data from one portco and use it for another one, how good is your conflicts discussion on that point? I know you've heard it a million times, but it's worth 1,000,001. Use of the word may doesn't get the job done if you're actually doing it. I know that's technically old news, but we continue to run into issues because disclosure that would have been really helpful for a fact pattern that's been given to us has the word may in it. And, you know, the SEC just has an issue with that. And then fund recaps, stapled secondaries. As you guys probably know, this is a major trend. The SEC is looking into them, and they're asking questions about it. And what are they concerned about? How is the valuation done? Did you get the approvals that were required? And were the right conflicts disclosed? With that, I would turn it over to Joel.
Great, thank you, Jason. So, you know, we're at 5 minutes to the hour, so I think now is probably a good time to just share the CLE code for today's presentation with everyone. I think that, you know, we may continue a little bit here with Q&A even, you know, over the hour because we have some good questions, but I want to be sure we get this to folks before anyone has to drop off at 1. So the CLE code for today's session is 5044. Again, that's CLE code 5044. CLE forms will be circulated to anyone who needs them in the follow-up email to this session, and participants can fill those out and return to cle.team@ropesgray.com. Again, that's 5044. So with that, I'm just going to speak very briefly to the next couple slides, and then maybe we can turn to some of these questions that we've gotten, because, you know, really these next two slides are, you know, ongoing issues. We see these in exams. We wouldn't describe them as necessarily a major kind of new area of focus over the last year. And some of these we've already touched upon briefly in earlier slides in any event. So That includes, I think, principal transactions and allocation of investment opportunities we have touched upon. AML programs, something that we see them inquire on, but not typically a major focus of private fund manager exams in the absence of some red flag. And similarly, cybersecurity. The SEC continues to reference cybersecurity regularly when they talk about sort of current priorities, including from an exam standpoint. In practice, what we've seen over several years now is there have been several different cybersecurity sweeps conducted by the SEC over about 5 years now. But we don't otherwise typically see a major focus on cybersecurity issues unless there's been a significant breach at the advisor. If you have had a significant breach, you should expect to be asked about it in detail during the course of an exam. Otherwise, not likely to be a major focus. Next slide. General observation, right? Compliance policies and procedures. There are often deficiencies in exams relating to policies and procedures, but usually those don't result simply from the SEC reading your compliance manual and saying, aha, there's something that's missing. It's much more likely that they've identified some underlying issue, and that underlying issue will then either, also, or in the alternative, give rise in the deficiency letter to a finding that your compliance policies and procedures were insufficient in some way. Custody rule, obviously a perennial source of potential violations. But I think, to the extent that there's a particular theme we see these days in custody rule section of exams, it's, are you actually identifying all of the assets that should be viewed in the SEC's view as client assets? So, things like co-investment vehicles, employee vehicles, it's important to think through what is the client status of those. And that kind of leads right into, internal vehicles, co-invest vehicles, just the SEC wanting to understand what's the position in terms of, is that an advisory client, and also how do both allocation of investment opportunity and expense allocation kind of play into those vehicles. Form ADV and Form PF, unsurprisingly, the SEC will routinely review those forms in connection with exams. And if there have been issues around timely filings, or if there's inconsistencies in those forms, that can be an issue. And then alternative data, data through web scraping or acquired from vendors, that's something that, again, the SEC has identified as an exam priority. It's not necessarily something that I see coming up regularly on exams, at least to this point. And where it has come up, it's been, in my experience, more the SEC, I think, and OC educating themselves about the issue. I do think, as this continues to be a significant source of investment ideas and investment analysis for our clients, I'm expecting that it will be something that we see more of a focus on from OC over time, both in terms of how do you diligence the sources of information that you may be buying out there in the marketplace, and what sort of contractual protections are you getting when entering into those agreements.
Hey, Joel.
Yeah.
We're at 1 p.m. and I just wanted to make sure, since some people are going to have to drop, I wanted to make a plug. You will be, if you attended this session, you'll be emailed a supplemental binder of materials. It contains some really great data about what we've seen on exams, sort of different categories and statistics. It has summaries of all of the SEC pronouncements that have been made over the past year and a half. It also has request letters and basically kind of every category of private funds. So be on the lookout for that. I think it's really, I think you'll find it very interesting and valuable reading. Sorry, Joe, just wanted to make the plug.
No. I had come to the end, I think, of at least my portion of the presentation. Would it make sense to just spend a few minutes answering some of the questions we've gotten, Jason?
Absolutely.
And I will put the first question to you, which really just relates to timing and frequency of exams. So I think the questioner said, private fund manager was examined in 2018. Sounds like a fairly benign exam. What would be your expectation in terms of when OC may be knocking on the door again?
Yeah, so look, I don't mean to punt. It's hard to predict. Here's what I would say. if you had a benign exam, I would expect the SEC to be back in maybe 4 to 5 years. Before 4 years would kind of surprise me based on my experience. But it could go long. I have clients that have gone 8 years, 10 years without being examined. So, it's sometimes hard to predict, but I would say 4 to 5 years, kind of at a minimum.
That all sounds right to me. I think, the SEC will say they do a risk assessment. So I think in part it depends on the size of the firm. It may just depend on how many different, kind of lines of business the firm has. And so what your overall risk profile looks like to the SEC. But I think that's a pretty good rule of thumb. Next question, maybe I'll field this myself. It says, what is the SEC's outlook on cross investment over multiple funds? And I think we've touched upon elements of that over the course of the presentation. I mean, I think it's certainly something that we see our clients engage in, not infrequently, where maybe fund X and fund X plus one are investing in the same underlying investment, or you have various different forms of sort of parallel investment arrangements amongst clients. And I think the keys are to first understand, certainly both from an investment allocation, are we allocating consistently with the applicable fund documents in terms of the investment opportunity? Have we gone through our allocation policies and procedures and documented that in the right way? And then also really be thinking about expense allocation, and especially with broken deal expenses. Does the broken deal expense allocation sort of align with what the investment allocation would have been had an investment been made, across multiple clients? And then I think, cross investment certainly can raise tricky issues on the back end, right? Sometimes we have circumstances in which one fund is really trying to dispose of its final investments and wind down, and another fund still has some runway left. And so that can give rise to all the sorts of, potential cross-trade issues, that we discussed earlier in the presentation. But those are things that really, you'd like to have some disclosure anticipating those conflicts. And then at the end of the day, you have to deal with those individual investment scenarios as they arise. Question, Jason, that maybe for you that I'll try and maybe simplify, but just kind of how you think about, in the context of allocation of expenses to co-investment vehicles, what would be considered a co-investment vehicle, and what would be, OC's or the SEC's expectation as to when, at least as a default, they would expect that a co-invest vehicle would bear some portion of, transaction expenses or broken deal expenses?
Yeah, so I would actually view those differently, right? As a general matter, if it is a deal-specific co-invest vehicle, or just, a co-investor, doesn't have to be through a vehicle, then I think the SEC has to date not expected them to bear broken deal expenses. As you can imagine, that would be tricky from a contractual perspective. They might never actually, invest. It's not like there's some, vehicle that's otherwise out there and could bear it. With respect to transaction expenses, I think the SEC has an expectation that, at the end of the day, it depends on the coordination that the advisor has. If someone completely on their own, makes an investment, then probably there's no allocation necessary. It's pretty rare in my experience. Usually, if you have like an LP that's investing, it's in part because the advisor coordinated that investment. And in that case, I think they would expect some sort of, sharing of other expenses.
Great. All right. I think, last question just relating to ESG related disclosures. And I guess the question was, sort of when does this come up, or maybe when is the SEC going to be focused on it? Is it, only if you're raising a sort of ESG fund, as it were, or, would that also incorporate a circumstance in which you were raising, just let's say a private investment fund of whatever kind, but as part of your overall disclosure, you said, we have an ESG policy and we're trying to do X, Y, and Z, from an ESG perspective with respect to every investment. And I think the short answer is, yes, this could come up in either of those circumstances. And we see the SEC look at sort of the alignment of your ESG practices with your disclosures in both of those scenarios. I think, unsurprisingly, the more that ESG has been central to the strategy of a given product or the disclosures you've made around a given product, the more likely it is that the staff is going to really do a deep dive on those questions in an exam. But I think, even if there have been, let's say, relatively less significant ESG disclosures, if you still say as part of our investment process, we impose some sort of ESG screen on every investment, you're going to want to be able to demonstrate that you've actually done that and that you've documented what you've done in that respect. With that, I think we have exhausted the substantive questions. Thank you all for sending those in. Thank you all so much for joining us today. We look forward to you joining us for the subsequent sessions in this program. Jason, anything else from you?
Nope, I'm good. Thank you all for attending.
Great. Thank you all so much. We'll talk to you soon. Bye now.